Hi everyone. Our topic today is capital expenditure planning and control. Capital expenditure planning and control. Expenditure on capital projects requires huge amounts of money, and hence it has to be thoroughly planned in order to avoid loss of financial resources or wastages of financial resources. There are cases when the equipment makes the business. For example, the aircrafts and the ship are the backbones of an airline and shipping companies, respectively. The significance of the above is that expenditure on them have to be properly planned and evaluated before a company commits huge funds into them. This one now leads us to capital expenditure. So we want to look at how we are going to plan the capital expenditure. So we'll be looking at the capital budgeting processes. Capital budgeting processes. So we'll be looking at capital budgeting process. So capital budgeting process includes number one, identification of investment opportunity. Identification of investments opportunity. Identification of investment opportunities. Here, a potential investor will search and identify various investment opportunities available. So, number two on the process, development of cash flow. Development of cash flow estimates. Development of cash flow estimates. That's number two. Here, the potential investor will estimate and project the expected cash flows from each investment opportunities or capital projects available. So the net cash flows from each investment can be, for example, let's say the potential investor is trying to prepare an estimate of cash flow for, let's say, four projects. Let's say project A, project B, project C, then project D. So the potential investor will now try to estimate the net cash flow that will be generated by each project. Let's say the net cash flow that will be generated by A are as follows. let's say year one project A will generate, let's say 800,000 in year one. Project B will generate, let's say 1 million naira in year one. Project C will generate, let's say 900 naira. Then project D will generate, let's say 1.2 million naira. So the potential investor will also estimate the net cash flow that will be generated by each project in year two, let's say 700,000. You also estimate this. Project B, project B generates 1.1 million naira. Then project C will generate, let's say 800. Then project D will generate, let's say 1 million. So continuously like that, the estimate will continue. It might be for 5 years, 6 years, or 10 years. So that's ways of developing cash flow estimates. So let's go to the number 3 now. The number 3. So we have here evaluation of the net benefits. Evaluation of the net benefits or net cash flow from each project. We want to evaluate the net cash flow from each project in order to determine the best, in order to determine the one that is most profitable and most viable. So the net benefits or the net cash flow from each project will now be evaluated to determine the most viable or profitable one. Various methods of evaluating investment will be discussed later. So you can go to number 4 now. Number 4, authorization to spend. That's number 4, authorization to spend. After the investment opportunities available have been thoroughly evaluated and the best investments or capital project is chosen, money or financial resources will now be spent on it based on the authorization. When large sums of capital expenditure is involved, the authority for the final approval may rest on the board or top management, which may be the chief executive of the company. So number 5, which is the last one, this one is control and monitoring. Control and monitoring of capital projects. Control and monitoring of capital projects. A capital project reporting system is required to review and monitor the performance of investments or capital projects during and after completion. It means that there must be a comparison between the capital budget and the actual performance. and the actual performance. So we want to look at this number 3 now, evaluation of the net benefits or net cash flow from each project. This is very critical to capital expenditure planning and control, and so we are going to concentrate on it. So we want to look at the evaluation of the net benefits or net cash flow from each project. So this is called, this number 3 is now called capital budgeting techniques. So this is a subtopic here, capital budgeting techniques. This is a subtopic. So these capital budgeting techniques can also be referred to as investment appraisal. It can also be called investment appraisal or investment appraisal techniques. It can also be called investment appraisal techniques. Investment appraisal techniques, capital budgeting techniques or investment appraisal techniques. And there are various methods or techniques for capital budgeting. So capital budgeting techniques can be majorly divided into two. Capital budgeting techniques can be majorly divided into two. Number 1 is non-discounted cash flow. 2, discounted cash flow. So we'll be looking at non-discounted cash flow. So the first one, non-discounted cash flow techniques. Discounted cash flow techniques. So we want to pick the first one now before we solve a question. You have question here. Let's pick the first one. Non-discounted cash flow techniques. So under this we have payback period. We also have this payback period can be shortened as payback period as this. Then we also have accounting rates of return. Accounting rate of return, which is also referred to as ARR. So let's look at the first one, payback period. Payback period. Payback. I want to look at payback period. And what is this payback period? What is this payback period? This payback period is a period of time in which the initial cash outlay, that is the initial capital invested, will be recovered. I repeat, I say payback period is a period of time in which the initial capital invested will be recovered. So we want to look at how to calculate it. And before we go into that, let's quickly look at the advantages and disadvantages of a payback period. Advantages and disadvantages of a payback period. Number one advantage is Payback period is simple to calculate. Number 2, it is easy to understand. Then let's look at disadvantages. Number 1, it does not put into consideration the time value of money. That's why it is non-discounted cash flow. It does not put into consideration the time value of money. Number 2, it does not include in its calculation the entire net cash flow. That is, its calculation does not include net cash flow after the payback period. So let's look at an example now of how to calculate the payback period. Payback period. So here is a question. Here is a question on how you have one question here. Question. So we have KK Limited is faced with a problem of whether to accept to invest in a project or not. The project requires 3 million naira and it is expected to generate net cash flow of 1,300,000 in year 1, 1.1 in year 2, 800,000 in year 3, and 1 million in year 4. If the management of the company had set the maximum acceptable period of 2.5 years, should the project be embarked upon? Before we solve this question, we need to look at the decision rule. Decision rule under payback period. Decision rule under payback period. Decision rule. So, number 1, decision rule accepts the projects if the calculated payback period is less than the company's standard payback period or the company's maximum set payback period. So, if the calculated payback period, if you calculate the payback period now, that is, if you solve that question, if you calculate the payback period, if you get the period of time that is less than the company's maximum set payback period, then the project should be accepted. But if the calculated payback period is greater or higher than the company's maximum set payback period, the project should be rejected. That is, the project should be rejected. So let's look at how we can solve the question. Then don't forget, there is another decision rule. This is decision rule 1. If you have mutually exclusive projects, that is, maybe we are considering 2 independent projects and we have to choose between the 2 projects. So under mutually exclusive projects, we will choose the projects that gives the shorter payback period. That is, the projects that will generate net cash inflow in which the initial capital outlay will be recovered faster than the other one. So we want to solve a question now, but this will be on our next class because of the time. Here is the question, but the time is not on our side. Let's resolve a question now.